What is the lifetime capital gains exemption? That answer right here, right now. I'm Rob Tatro from robtatro.com, portfolio manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. Today is a fun topic. I'm really excited because we're talking about the lifetime capital gains exemption. Business owners out there, you don't know how it works, you've come to the right place to get answers. Before we get to my guest right here, take a sec to subscribe, like our videos, give us a share and a follow on YouTube, wherever you're watching this, Instagram or LinkedIn or wherever it may be. And also, if you'd like to book a no obligation consultation, go to www.speaktorob.com and we'd love to do that for you. My guest today, Head of Wealth and Estate Planning, none other than Adam Buss. Adam, thanks for joining us.
Thanks for having me, Rob.
All right, you're kind of a mini celebrity here on the YouTube channel. Whenever we got planning questions, we always like to bring you in. You are a CFP, Head of the Wealth and Estate Planning Group here. So Adam, we're talking about the lifetime capital gains exemption. What is it?
So that is an opportunity for business owners who are selling their company, when they're selling the shares of their company, to get a whole bunch of money tax-free. And who doesn't like tax savings opportunities? Lifetime capital gains exemption means that the first ballpark $900,000 of the increase in value on those shares is tax-free. Now, depending where you are for province-wise, that's probably a $250,000 tax savings. So you multiply that by maybe husband and wife, two partners in a relationship, that's a big tax savings that, again, puts more money in their pocket towards retirement versus in the government's hands. And that's a legit thing that exists that you can take advantage of.
No one's cheating.
Nobody's cheating. There's no loopholes. It is legitimate. Just as a way of trying to save some tax on the qualified sale. Now again, certain parameters, the small business corporation has to be considered qualified, and there's a few different prerequisites for that. But again, getting that advice ahead of time before selling it, you can make sure that everything's properly structured so that you can get some tax-free money. Why not?
I love tax-free money. So you talked about the typical tax that you would pay on that. So obviously you only get one of these in your career, in your lifetime.
Right, yeah.
It's a lifetime capital gains exemption. If you use a little bit, you get to carry over the rest.
Exactly.
And now we're talking about roughly 900. It's indexed, it'll increase over time. So if there wouldn't be a capital gains exemption inside of a corporation, on a share sale, that would be, you'd be paying
capital gains tax
based
on the full gain in value on those shares.
Roughly 25% depending on your province.
Yeah.
So it's roughly the top tax bracket divided in half. Now, we talk about the tax savings for the spouses and the kids. Do they automatically get it if they're shareholders?
It depends on how they own the shares. If it's owned personally, corporately, it can be a little bit more complicated. That's why you want to work with a team of individuals such as advisor, financial planner. We'll coordinate with their accountant, their lawyer. We want to have the entire team working towards that same common goal, which is trying to save them some money on tax. But again, the shares do have to be personally owned. As an individual can have the lifetime capital gains exemption, not the corporation.
Obviously, you do have to be incorporated. You can't do it on a sole proprietorship sale.
Correct, yeah.
Obviously, it cannot be an asset sale. If you're selling a piece of your business that's an asset and not a share sale, it will not qualify. A couple things for you to notice. And obviously, the other big one is that once you're getting into a situation where you're planning for this, right? So you think you're going to be selling your business maybe in a year or two, you can't start thinking about this the week or the month before your sale, because sometimes you need to purify the books, you need to have a clean balance sheet, and your accountant will give you some piece of advice to implement ahead of the share sale.
I would say at least a 2-year window before the time of sale, just to give yourself that runway. Purify the corporation, which is removing excess non-active business assets, might be cash in an investment account, could be a rental property, from that corporation, so that whatever you're selling is essentially just the active company.
Right. We want to be basically moving the cash to a holdco or to another investment vehicle at that time. All right, so it makes a lot of sense. You get one of them, use it wisely in your life, make sure you're planning ahead of time. If you can save 250 grand, 250 grand of tax just by properly planning, you should be considering that. So guys, remember, take a sec to subscribe, like, follow, and share. Also, go to www.speaktorob.com if you'd like to book a no obligation consultation with us to chat about this or anything else in your investments or your corporate structure. I'm Rob Tatro from robtatro.com, portfolio manager here, Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group, along with Adam Buss, head of wealth and estate planning. Thanks for watching. We'll see you in the next video.